Hey guys, Bryson here, and welcome to my show. And today we're going to be reacting to Warren Buffett himself and actually find out exactly what he thinks whenever the stock market is actually going down and also going up, and what he thinks about people who basically invest based on just the price and the price it actually used to be at. Now, I'm making this video here, guys, because basically right now with everything that's going on in the market, a lot of people are forgetting about like what Warren Buffett says and what the stock market history actually shows us about investing. So I want to make this video to give you guys a little background. I'm basically the biggest investor ever, like Warren Buffett, like worth like around like $90 billion, something like that. The answer is I want to go over this video to see exactly what he thinks about all the volatility in the market. And by the way, guys, I also upload videos on this channel every single day, so make sure to also subscribe to the channel and hit the bell so you're notified every time I post a new video. And on top of that, also destroy the like button. Without further ado, let's see exactly what Warren Buffett thinks about volatility.
Our special guest this morning is the chairman and CEO of Berkshire Hathaway, Warren Buffett. And Warren, we've talked about a lot of things this morning.
It's insane how Warren Buffett started investing when he was literally like 11 years old. I know his dad was like had his own company and stuff like that, but 11 years old and read like vividly like almost every single investment book in his entire like library. To me, that's insane.
Briefly, your thoughts on the markets, but there's been a lot that's happened in the markets since the last time we sat down with you. Volatility is back in a big way, and that has the average retail investor kind of questioning what to do at this point. It's scared a lot of people. What do you think's happening right now?
It's interesting how she says, you know, volatility is back, because volatility has been here like forever. Like volatility has always been a part of the market. It's always been ups, it's always been downs. It's like a normal thing. I want to see exactly how Warren Buffett responds though.
Just in terms of the return of volatility, is it something to be worried about? What's causing it?
Well, if you own stocks like you'd own a farm or apartment house, you don't get a quote on those every day or every week or anything. You look at the business, and the value of American business depends on.
Yeah, you know, I love like he always has like the one or two examples he always uses all the time. And that's the farm or an apartment or real estate or a piece of land. And the idea is that if you own a piece of property, or for example, if you own a company and you know the company is solid, it doesn't matter what the stock market says about the company, because basically you know the company is solid and is going to continue to do well. Same as a farm, okay? If you have a house, for example, okay, and you buy the house at 100K, and somebody comes to you and says like, hey, I'll only give you like $90,000. You won't get mad about it, be like, okay, I'm not selling, I'm sorry, right? But a lot of people, whenever like the stock market goes down, they feel like, hey, I have to sell because basically that's what the market is offering me. In reality, you don't have to sell. You can hold on if you know you have a pretty good company.
How much it delivers in cash to its owners over between now and Judgment Day, and I don't think it changes in 10% in a 2-month period if you're looking at it as a business. Now you've got.
By the way, by Judgment Day, he means like between like now and by the time the business actually ends, because every single business has a cycle. Businesses end. That's a normal thing. It's part of the game. But the answer is for long-term investors, you have to keep analyzing companies over time to understand exactly how is the company's health actually doing. And sometimes you might have to make an adjustment like Warren did in 2020, where he actually sold the airline stock that actually had, because basically the fundamental strategy of the airline business is going to change because everything that's actually going on right now. But for me, I actually bought more airline investment because basically I'm investing even for a longer period of time than Warren will still be here around for, most likely.
Anything can happen in markets. I mean, anything can happen in markets, and that's why I say don't ever borrow money against securities. That markets don't have to open tomorrow. I mean,
that is very scary. That's very scary. You know, the idea that, for example, the stock market doesn't have to open tomorrow or the next day, or they might actually close it down, or for example, like, hey, maybe the entire economy is going to collapse. The answer is it's a possibility. And I think for us, like, you know, like if you're less than like 30 to 40 years old, usually you don't think about it that much, right? Because Warren is like 80 something years old. So he's seen the stock market basically, there was a period in the stock market, basically it closed down for like 3 to 4 weeks, I think. Like literally. On top of it, was a period where basically it was a bear market for like around almost 20 to 25 years, which is also crazy. So the answer is he's seen the worst of it. So basically he's like, hey, anything can happen. But for us, kind of like, you know what? The worst that can happen is like, you know, you lose 20%, but like it'll recover back in like a few months or whatever. And the idea is whenever you hear like, hey, every single stock market downturn has ended up in recovery, that's true, right? History shows that. But the idea is they don't mention that, hey, that recovery might last a very, very long time, up to like 20 years or so. Okay, so the answer is you never really know what's gonna happen. And that's why you want to make sure when you're investing the correct way.
Can have extraordinary events. So I think to some extent you can get some of the instruments that people don't understand very well that have a lot of firepower in them.
Like
and
the volatility
they
index
can
and
trigger.
things that are
Yeah,
tied
and
to that.
the idea of people taking a position, and they're gambling. They're not investing. Nobody's investing when they buy, some supercharged index on, on how the VIX does or something like that. They don't need it in their life. It's an unnecessary instrument. Now,
Oh, he's talking about people that basically invest into investments that basically the volatility is so high that today you can make like 40%, but tomorrow you can lose like 90% of all your money and it can be gone just like that. He doesn't like those whatsoever. And I agree with that also because, whenever you're investing for like the long run or like investing like a proper investor, usually you want to make sure that your money is okay. And by the way, I love movies like with a lot of action, but I don't really want a lot of action in my portfolio. I don't want to be up one day 20% and then tomorrow like down like 40%. That's horrifying, So whenever you invest, you want to make sure you're investing into solid companies. I understand that. And by the way, he also talks about people that invest on margins, which basically means if you're investing money and you're borrowing money to invest, well, now that actually another layer of actually more stress on you, basically because if the market goes down enough, you have to sell some of those investments and you might actually end up losing a lot more money than you actually think, okay? So it's actually very dangerous. I understand this so far.
they will create instruments that the public will buy, and you can just count on that. Wall Street's been doing that since they met under the buttonwood tree in 1792 or whatever it was on the exchange. So, but if you're investing, if I'm going to buy a half interest in a McDonald's stand and you're going to run it, or McDonald's franchise, and you're going to run it, I look to the business to determine whether I made a good investment. And I'm concerned about.
Yeah, that's the best way to do it. If, for example, say I have a business, guys, and my business makes, say, for example, $40,000 every single year, okay? And every time I actually make this money, it only takes me around like $10,000 to actually make this money. So the cost of goods is only $10,000. The profit is $30K. It sounds like a very good business, right? It's pretty solid as an example, right? However, the stock market says that my company is actually not worth that much. But I've been making this much money for the past like 10 to 20 years. The answer is the stock market correct? The answer is no. You look to the business financials to find out exactly how the business actually is. And that way you can decide exactly, is it good? Is it bad? Do I sell? Do I buy? Or do I hold? That's the answer. The business is the answer, not the stock market. The stock market is heavily based on human emotion, which is very dangerous.
Whether we have new competition, how we do over the years, but it's the business I look at. When you're just looking at the price of something, you're not investing. I mean, if you buy something, Bitcoin, for example, or some.
And by the way, guys, I see a lot of people that basically, the way they invest is basically, they look at the stock price and they look at what the stock used to be like, for example, like 52 weeks ago, and they say like, hey, it's going to go back to that price, so might as well invest right now and then cash in when that comes back. But the answer is that is speculation, and you never really know what's going to happen. The company might actually go bankrupt if you don't know exactly what's going on behind the scenes. And behind the scenes means the balance sheets, the cash flow statements, the income statements, the 10K forms, the 10Q forms, all the financial statements that are public whenever you invest into a company.
Cryptocurrency, you're not looking to the asset itself to produce anything. If you buy an apartment house, you're looking at how the apartment house does. If you buy a farm, you're looking at the farm does. If you buy a whole business, you're looking at how the business does. If you buy a part of a business, why shouldn't you look at how the business is going to do? But people get charmed by.
Yeah. And a lot of people basically talk about a cryptocurrency, but cryptocurrency, like currently right now at least, it's the game of like, hey, how can I buy low to then sell to some other guy for higher because he thinks it's going to go even higher, okay? It's a game of trading, basically. It's not a game of like, hey, how much money is this actually going to produce? How much is it going to make me? Because it's not really like an asset in a sense, right? At least currently, you don't know what's going to happen in the future, but currently, it's not a good investment. And Warren says it. I say it. Charlie says it. It's a dangerous game when you're just like playing like, hey, I'm going to buy low, sell it to the next guy, and hope he pays more for what I actually bought, okay? Very dangerous game.
By lots of action and the fact that things are liquid and all of that. And it does have repercussions back into the market when you get something like, an ETN arrangement on the, supercharged on the VIX. I mean, where you can lose 90% of your money in one day.
Imagine that. Imagine something and then losing 90% of your money just like that. It's insane. I
mean, that really doesn't belong with the word investment. I mean, it's a gambling form of activity.
Although you've said you're.
Yeah. This is definitely gambling. A lot of people think they're investing, but in reality, they're gambling. And by the way, investing as a whole, guys, anybody can do it, okay? All you really need to is the right information. You need a little accounting skill, a little finance skill, and that's all you really need. You know, like all you're really doing is analyzing a company and finding out the actual value of it, and then basically saying like, hey, how much is the company worth per share? If it's actually below that, you're buying at a discount. If it's above that, you're buying at a premium. That's the entire idea, like buying things at a fair price and holding on to them as long as the company is pretty solid. It's very basic, but again, no one wants to invest for like 10 to 20, 40 years to then get rich. Everyone wants to get rich right now. And that's why every single investment out there sounds so promising, because basically they'll promise different things, okay? Oh, go out there and do day trading, go do cryptocurrency, go do a whole bunch of different things, okay? A lot of times that's mostly gambling. Derivatives, very difficult, complicated investments.
You talked about this in the annual letter over the weekend, and just even at the top of the show, where when you look around for a business that you want to buy, you can't find any at attractive levels. However, when you're looking at equities, you do see that as a good place. That Berkshire has been a net purchaser of equities this year.
By the way, Warren Buffett actually said that whenever, like, for example, he invests and actually buys more, right? So he's actually looking to buy a whole piece of a business almost, right? But whenever we invest as like smaller investors, we actually have upper hand above him, because basically we buy things at a discount compared to what he would actually pay for the premium of buying an entire business. And on top of that, he says that, hey, we're dealing with much smaller sums of money. You can actually make a lot more money on top of that. Because imagine like trying to get a 50% return on $128 billion that Warren Buffett is currently sitting on. It's very, very difficult, almost impossible. But getting a 50% return on, for example, $10,000 or $100,000 is a lot more simple.
In 2018, and that's because you like the deals that you're getting in the market.
You can buy small pieces of businesses for less than you can buy whole pieces of businesses.
For the premium you'd have to pay if you were buying the whole thing.
Exactly.
So you get a bargain as an investor compared to what I can get in terms of buying the whole business. And people, if they just think of stocks as pieces of business, they'd be so much better off than thinking of them as little things that move around in price. And I think with Berkshire, we have an unusual number of people as shareholders.
Yeah. You know, that entire concept of, for example, like, you know, stocks, pieces of business, he gets it from Benjamin Graham. That's who taught him all this stuff, you know. And the idea is when people look at stocks, they look at, for example, like, okay, so Robinhood has this and that, so that's what I'm looking at. It moves around up and down. In reality, what's behind that little piece of paper, or for example, Apple, whatever it is, it's just a business, right? So at the end, all you want to do is analyze the business. If it's a good business, you're good to go. If it's a bad business, don't invest into it and move on.
Who just look at Berkshire as a business. They look at it as a savings account. They put some money in 20 or 30 or 40 years ago. We retain it and reinvest for them, but we're their savings account.
The crazy thing is that if you had invested some money in Berkshire Hathaway 40 years ago, you would have a massive amount of money right now. And, you know, the core foundation of what Warren does is just like simple investing. You know, it's value investing. By the way, when he says like, you know, everything is simple, it's not simple, right? It's a lot more complicated than he leads on, because basically he wants to make sure people go out there and find out and discover things. If it's too difficult, people won't be interested in it, all right? But the idea is that the basic idea is that you buy good businesses and you hold on until the lights go out, right? That's the idea.
That's the way I look at my own stock. That's the way Charlie looks at his stock.
Part of the reason that you've been so bullish on equities for many years at this point is the interest rate environment. You've looked at interest rates and said interest rates are gravity on stock prices, and when interest rates are so low, stock prices inevitably are going to climb. There's been this really weird thing that's been happening in the market.
By the way, it's very interesting. You know, when interest rates actually go lower, like she said before, the stock market tends to climb, but also when unemployment actually goes up, usually the stock market also tends to go up. And I made a video about this in the past because basically there's been 8 instances in history where this actually has happened before. 8 or 6 instances, okay? So it's very weird how the stock market operates, okay? Because again, it's all on perspective and what people actually think about the economy.
Where all of a sudden, good news that we got from a good jobs report made people start to worry that interest rates were going to climb and that the Fed was going to raise rates more than anticipated. People got really nervous around that, and you can still see it.
Yeah. So the idea is, for example, if the Fed cuts rate to actually, you know, like stimulate the economy. By the way, the federal government, you know, the Treasury, stuff like that. The idea is that when they cut rates, the entire idea is that, hey, we're gonna cut rates thus put more money into the economy and help the economy grow. When they when they actually increase the rates, usually it slows down the economy a little bit. So people get like, okay, they're gonna raise it back up, so now let's take out our investment because basically things are gonna go back down. That's how the mind of an investor works, okay?
Every time we get up on the 10-year back towards 3%, it gives investors, or at least traders, I should say, some concerns about what's happening. How do you kind of gauge
Becky,
all
a
of that?
bond, if you buy a 30-year government bond, it has a whole bunch of coupons attached. In the old days it does, now it's electronic. But it has a whole bunch of coupons. And the coupon says 3% or whatever it may say. And you know that's what you're going to get between now and 30 years from now, and then they're going to give you the money back. What is a stock? A stock is the same sort of thing. It has a bunch of coupons. It's just they haven't printed the numbers on them yet, and it's your job.
Yep. That's the whole thing, man. That's the whole thing. And so far, guys, to avoid making this video very, very long, I'm going to pause it. I'm going to end it right here, okay? But if you want to watch this interview, it's an interview with Becky Quick, and it's on CNBC. You're gonna love it. Watch the whole thing. It's like an hour long, but it's actually very, very, very good. And the general idea is, guys, you know, is stock. Usually you can predict exactly how a stock is going to perform based on its past, because at the end of the day, it is a business that shows you exactly, hey, here's how much money we actually made last year, this year, and how much money we predict to actually make next year, okay? Well, your job as an investor is to calculate exactly, well, how much is this company right now worth, and how much should I actually pay for this company? That's the overall idea whenever it comes to investing. And I made this video because right now with all the volatility, a lot of people are going to be selling. A lot of people are going to be losing a lot of money, and because a lot of people are basically impatient, okay? So I want to make sure that you, if you're an investor and you watch my channel, you understand why I invest the way I invest for the long run, because basically all my ideas come from example from like Charlie Munger, Warren Buffett, John C. Bogle, James Allen. It's just like all Benjamin Graham, like all of these like great investors, and that's who I actually take advice from, you know. But I'm not a big fan of day trading or anything like that, because basically the math shows that it's super risky and around 80% of them usually lose money. So I'm not interested in that whatsoever. But comment down below guys and let me know, was this video helpful? Are you investing? Have you started? And if you haven't, well, check out my main channel, Bryson, because basically I post there also every single day, and that way you know exactly the basis of investing and how investing actually works. I'll see you guys next time. Thanks for watching. And as always, if you enjoyed the video here, well, like this video, subscribe to the channel, and hit the bell so you're notified every time I post a new video. On top of that, follow me on Instagram, Bryson. And on top of that, if you want to watch another video on basically what Kevin O'Reilly thinks you should actually pay for a first date, here it is right here. I'll see you guys tomorrow. Thanks for watching. And as always, peace.